Oh, good morning, everybody. It's my pleasure to welcome you to what I think is the second session of today's Private Equity Summit. My name is R.Braun. I'm an academic with Technical University of Munich. So if we had the pleasure to be together today in physics, I had a home advantage. But I think that has disappeared because we gather today digitally. And it's my pleasure to have this or moderate this session with two senior great experts in private equity. Eric, who's with Flexstone Partners, and going to introduce himself in a second to you, and Peter, who's with Milbank here in Munich. Eric, would you like to start to say hi to everyone?
Sure, thank you, Rainer. Hi, everybody. So my name is E.Deram. I'm the founder and one of the managing partners of Flexstone Partners. So I'm based in Geneva, Switzerland. We have 4 offices. In addition to Geneva, we're present in the US and Europe and Asia. We manage roughly $9 billion in private equity, whether it's fund of fund, co-investment funds, and secondary funds. And of course, today we're going to talk about co-investments, and we're currently raising a co-investment fund, a global mid-market co-investment fund.
Thank you, Eric. Peter, would you like to continue?
Happy to. I'm a private equity lawyer on the transaction side. And on the same time sitting on some boards, including one of a large institution doing both, having a large fund of fund business as well as doing co-investments.
Great. Thank you for the very short, brief introduction. Very interesting. And the audience has already realized that you guys are very experienced and very well qualified to talk about our today's topic, which is co-investments. And I have to say that, like a good academic, I was a bit, late in preparing some content, and we didn't manage to get that here to be streamed to everyone else. Because we wanted to give you guys, the audience, an impulse by sharing current market data with you. And but I think we can easily verbalize, because I think it doesn't come as a surprise that actually for both perspectives, from LPs demanding for co-investment, but also for GPs actually trying or aiming at meeting this demand, co-investments become a more and more popular topic, right? So basically, if you are interested, maybe we get the chance to share that with the audience in hindsight afterwards. We were resorting on a recent pre-Quinn investor survey. It was basically saying that around 40%, of investors already, having exposure to private equity are, considering actually, doing co-investments over the next 12 months in 2021, and that this demand, for these kind of transaction is largely driven, let's say, by what we could call mid-sized limited partners, which are somewhere between 1 to 10 billion of investing into private equity, right? And this is a group, maybe we get the chance to talk about this later on, let's say a mid-sized, so to say, group of LPs that even has a strong increasing appetite for the asset class. So while only below 40% of these investors are already doing private equity, more than 40% in addition would like to do these kind of deals in the near future, right? And similarly, as I quickly mentioned, the same pre-Quinn study actually also asked private equity fund managers, whether they actually plan to offer alternative structures, alternative in the sense of, beyond their, let's say, core business. And there is a number of already almost 90% of those fund managers who said that they want to offer more, or at least the same amount of co-investment opportunities to their investors as they have already done. So as I said, sorry again for the inconvenience to just verbalize that here in the stream. There's a strong interest by LPs but also GPs, obviously, to meet that demand in the market. And so I would like to, translate this into the first question now to the panel, whether this actually matches, your own reading and experience in the market these days, and whether this actually also meets your expectations for the upcoming months. But before I do so, a little remark. I think because we are the second session only, please, we invite you, to share your questions in the chat. So I think the more interactive we can get this to happen, although we are in the digital format, the more interesting. And we also have an interesting poll, on your favorite form of co-investment exposure. So I would like to engage you to participate in that. But before, so Peter or Eric, the numbers I've just read out and that we shared within our group, is that in line with what you observe in the market right now?
Peter, you want to take this first, yeah?
Maybe just we see on the actual buyouts, we are advising either on the buy side or the sell side. I think, yes, the interest is there, but I would see a significantly lower number of actual co-investments. So if you look at the transactions, they are more often, in particular, if they hit the sweet spot of the respective buying fund from the investment side, I think they are more often than not just doing it by themselves. One of the reasons being that there's still the pressure on the funds to basically get the money which they have been entrusted with invested. If you have situations where, let's say, the investment is higher than the typical investment this particular fund does, then of course they are looking for co-investors. There may be strategic interest sometimes that, I don't know, be it from the process or be it that another fund or co-investor has already maybe a strategic participation somewhere which matches this. This can play a role. And then, of course, you have in the background certain arrangements with large LPs. If they basically put some pressure on you and say, yes, but I want to have this or that opportunity, which is not always transparent, at least on the deal side for guys like myself. So to sum up, I think from my perspective, at least, we see less co-investment than these numbers would suggest.
Okay, it's interesting. I mean, from our perspective, we've been doing co-investment since 2008, and we've seen a big evolution, over the last 12, 13 years. But the only way seems to be up, to be honest, going back to your numbers right now. I think co-investment is very useful both for LPs and GPs, and we can, discuss why is that the case. But what I'm struck with is two things really. The first one is co-investment have evolved substantially over the last 12 to 13 years in terms of complexity. It used to be a GP does a deal, and the deal is a little bit too big for the fund size, and therefore they offer co-investment to the preferred partners. Today, there's a variety of different ways you can co-invest. Obviously, co-investment at the initial stage is still, very much, something that we do. But throughout the life of an investment, and when the GPs tend to create value more and more through operational improvement, buy and build, and other type of strategy, you get to see co-investment opportunities more and more at the later stage of the deal life, if you will. So that is the first comment I would make: increased complexity and increased interest, to be honest, for LPs to do co-investment, for us, as a co-investment fund manager. And the other trend I would see is that if you look at all the major asset gatherer in terms of the fund manager who do fund co-investment, etc. It was not really the case 15 years ago, but today most of them, if not all of them, have a co-investment fund offering. And these funds have become bigger and bigger over time, together with the increase of the assets under management within the industry. So I would tend to concur with you. And to be honest, we're deploying a 750 million euro fund right now, and we're really swamped in terms of deal flow.
Okay. Interesting. So maybe something later when we would like to have or take your questions. So maybe if someone in the in the audience would like to share his or her view on own observation, whether that's an increasing or decreasing number that we observe right now. But Peter, I mean, you mentioned an interesting a point in that I would like to pick up here. That is it really that all LPs that you typically work with or that you see across the board are seeking co-investment opportunities? Or is it that you see that a particular large, sophisticated professional organization, try, for example, to reduce the average cost on their private equity exposure, are seeking for that? Or and has that changed over time? Or is there any pattern that you could observe?
I mean, in generally, it's clearly the latter. So you have the sophisticated, large institutional investors who, since many years, I think, have put in side letters or other forms requests for the possibility of co-investments, partially to get down their cost. Indeed, but I think also just to see more, be more in the deal flow, and they are also the ones who typically do have in-house capabilities to then look at that stuff. But I think you are right. The trend is obviously to a broader part of LPs. I mean, that other people are also interested, and you see this, for example, in the family office area, where you have by now a number of players, in particular also for smaller or mid-cap buyouts, who are interested either to do even direct investments or at least do co-investments. And so I think, yes, the trend is that there is a broader group of having such interest.
Eric?
Yeah, no, look, I totally agree, and one has to differentiate indeed the type of LPs. I mean, the very large LPs or the highly sophisticated family offices, they have a dedicated team, which are really direct investors, and they prosecute co-investment opportunities directly themselves, right? But one has to remember that, at least for us, co-investment, you have three key factors for success in co-investment. Otherwise, as your research has shown, and perhaps other academic research has shown, you don't necessarily overperform beyond the fact that you most of the time don't pay fee and carry, which obviously makes a big difference. But if you really want to try to overperform in terms of co-investment, you really have three factors for success. The first one is the quality of the deal flow. And as a firm, most of the capital we manage is actually investing in funds. So we have relationship with 400 plus fund manager on a mid-size, small and mid-cap segment on a worldwide basis. And this really is the source of our deal flow. And it's a qualified deal flow because we obviously invest in good fund manager for our primary capital. There's no conflict between the primary and the co-investment side. So it is really a qualified deal flow, which is not necessarily the case when you don't have a big primary program. And on top of that, if you have a big primary program, you get the co-investment opportunities on a no fee, no carry basis. If you don't, that is not necessarily the case, and therefore it beats the purpose a little bit. The second key factor for success in co-investment is really selection skill. And we can debate this, at length. We've done a lot of research. You have done research on, adverse selection. Other academics have done research on other aspects of co-investment, but skill selection is really, in our view, very important. And the third one is, obviously, you need to have a process. Because GPs, by the time they call you for co-investment opportunities, typically they're only weeks away from closing, right? And you need, as a co-investor, professional co-investor, and if you want to be successful and if you want to see the next deal from the GP, right? You need to be able to execute that transaction in a timely fashion. So you have the very sophisticated investor who do that and have the team to do this themselves. And most of the others actually, invest via co-investment funds such as ours, and which, goes back to what I was saying about the size and the number of co-investment funds fundraising out there.
Okay. Thanks, Eric. By the way, thanks for mentioning our research. And I think just 2 sentences for the audience.
Yeah, it's very interesting.
Yeah,
you should share it.
Yeah. Thank you. So what we basically have shown in the research is that there is no adverse selection going on, in the sense that GPs, select, inferior assets or so that they offer to the LPs and keep the best ones for themselves. So it's rather, at least in our sample, a random selection. So you could actually, as an LP, get a very good or a very bad one. So there is no, let's say, a deliberate action, by the GPs. And as you were saying, at least in our reading of the data and understanding, then for an LP, it comes down to do it properly, right? Build a portfolio, so to say, to mirror the return distribution in private equity, which is that, fund returns are very often in a positive way driven by some outliers. So if you do co-investments, okay, you need to somehow, naively speaking, increase the odds, the probability of hitting one of these very good deals too, right? So that's at least, our reading of the data. So, feel free to contact me if you want. Eric.
Yeah, can I pick up on this? Because I think this is very interesting, and it's always been our view. And again, we've been doing this for, more than 12 years now. But we've actually kind of expanded on this. And there's other research which shows that, GPs, regardless of the sectors, specialties, etc. And I heard Peter mentioning the sweet spot word earlier, which is very key in our deal selection. If you look at GPs, and research has shown this, the GP, they tend to do very well in a certain amount of sectors or specialty type of deal geographies, etc., which we define as the sweet spot. And research has shown when a GP does a sweet spot deal, they tend to return on average 2.2x. But then, you have all those outliers, which are the opportunistic transactions, which are not necessarily core. And research has shown that those outliers, they return on average 1.3x. And as a co-investor, if you think a little bit about it and expand this into your selection process, we've decided that we would only do sweet spot deals from GPs, because when you do co-investment fund, it's a diversified fund of 40 to 50 deals. And if you hit the sweet spot and you're on average 2.2x, and you don't have fee and carry to pay, the odds are that you are consistently going to return 2x net to your LPs. And that's how we've expanded that notion of the sweet spot to select only the sweet spot deals and get to those 2x return net to the investors over time. And I think it's almost mathematic, if you will, or data driven at the very least.
Yeah. Peter, we'll hear your view in a second, but can I, if you don't mind, Eric, so what you're basically saying, and it's a bit of a hypothesis, I'm trying to generalize, is that it means also that LPs maybe to a very large extent, base their decision just on trust, that the GP knows what she or he is doing, which obviously is more likely in the sweet spot, right? Is that your experience? Maybe Peter also is. What would you say? I mean, I don't know whether it's easy to make to give percentages or attach percentages to that, but I'm making this up. So maybe more than 50% of many LP decisions is rather based on trust or established relationship with the GP, trusting they know what they're doing, rather than own due diligence or selection skills. Is that something you would buy into or disagree?
Yeah, no, I would totally agree with that. And that's why we need to go beyond that, right? Because even the very best GPs, they tend to do bad deals from time to time, right? And you need to avoid those if you want to return to X net, right? So we built this tool which looks at, the skill, the sweet spot, which tries to define, in a data-driven way, what is the sweet spot for a certain GP. And we would only do, the deals which are really square into that sweet spot definition. And one of the things that would be interesting to discuss if we have a few minutes is your new research about defining the importance of the specific GP, i.e. individual within a firm which leads the transaction. So in our sweet spot analysis, this is one of our criteria. we know the GPs so well because we're a fund investor and we are on the advisory board of those GPs, etc. We know which are the outperformers and the underperformer. And we would only, and that's one of our sweet spot definition, we would only do a co-investment with that specific individual and not that one, if you see what I'm saying. And as you know, it explains a lot of the performance of a firm as a whole. So it really goes into the detail of the data. And I think, you know, obviously trusting the GP is very important. You know, there's a good brand name and there's good historical returns on this. But if you co-invest, you know, with the wrong individual in outside of the sweet spot, well, the odds are that you're not going to get a good result.
Yeah, yeah. Thank you. And I'll get to the research in a second, but implicitly we're already talking a bit about our experiences of do's and don'ts of doing co-investments. And Peter, I mean, you know, maybe you could, I mean, you've seen many of these transactions. I mean, could you say there are, you know, do's and don'ts or good or bad reasons for doing co-investments in your experience?
I mean, the most important thing is probably don't just do a co-investment because it's offered to you. And sometimes I think, at least in earlier times, that was a little bit the reaction. That's kind of, oh great, there's an opportunity, let's jump on it. Yes, it has something to do with trust. Often co-investors are existing LPs of a fund, or you have other relationships because you have done other co-investments with them, etc. So there is typically an existing relationship there, and I would suspect some form of trust. But in general, we also shouldn't, how shall I say, overestimate, even if you have a team in such co-investor, how much work they can actually do. I mean, typically they do piggyback on what the GP does on the deal. So yes, sometimes they take a legal advisor and look at some of the documents, but actually more often it's then the relationship as co-investor. What are your rights in the co-investment agreement, etc. And then basically really reviewing legal due diligence reports, the transaction documents itself, etc. Maybe a little bit, but not too much. But definitely, for example, I haven't seen a co-investor who hired itself a financial advisor or someone who does a financial due diligence or a business due diligence or whatever. They are, at least what I have seen, typically piggybacking on what has been prepared by the GP. And therefore, there has to be a relationship of trust because, as we all know, whoever basically instructs such due diligence has certain priorities, is asking for certain things, is to some extent influencing what you get as a result. And therefore, you are relying on the work the GP has done.
I totally agree with that. And I think the best image is actually you sitting in a car, right? And you're on the passenger seat and the other guy or the other woman is driving the car, right? So you have to have that trust, otherwise you're not getting into that car, right? So, but you know, you're sitting next to the lead investor, so you still have some influence. You can say, well, I think you're driving too fast, or you know, if I pull the analogy, so you know, a good co-investor will make sure he's getting into the right car, but along the way he will exercise some influence. You know, in due diligence, of course, but also, you know, once the investment is done. I think you're totally right, Peter, but there's still some, you know, quite a lot of things that you can do as a co-investor, even if you're a minority investor.
Okay, great. So if Peter and Eric, if you don't mind, let's already a bit ahead of time than we initially planned. Obviously, there are a certain number of questions already in our personal chat here of the panel, and you don't have to look that up because I think that there is one overarching question that I've seen in several of the questions that have been posted there is that, you know, the look ahead. So if we, you know, take a snapshot of today, I think many LPs we've talked about is have increased their exposure to co-investment or direct exposure. Many of them, of others, are still interested. And but what are what is your view on the next month or years to come, right? So there are several trends that the whole industry is facing, right? Many people are expecting a macroeconomic downturn, but at least a threat once quantitative easing is ending up. And it raises certain question, in terms of the riskiness of such a strategy. And two aspects that were mentioned in the chat here related to this. First of all, whether you would actually see pros and cons of going rather in a globally diversified portfolio, or rather focusing on certain geographies, right? And the second one is the extent of aggressiveness in terms of leverage use to do this, or rather go rather conservative on this, considering the current macroeconomic trends. Do you have any views on this?
Happy to take a stab at this. So obviously we're raising a global co-investment fund, so in the small and mid market, and so we believe there are pros and cons in each of the main geographies. Obviously, the US market is by far the most sophisticated private equity market, where we have the most deal flow. Now, if you look at the numbers, especially in terms of leverage and in terms of enterprise value, we seem to be at an all-time high currently. And that's probably driven by all the fiscal stimulus that we've seen in the US, and the expectation from the governments, from the investors, that the US is actually going to be overperforming the rest of the world over the next 12 to 24 months. And I think there was a publication overnight that they expect GDP growth of 7% in the US, which is the highest in the last 40 years. So that would explain the valuation. On the other hand, in Europe, people expect the continent to be a laggard in terms of development and GDP growth. On the same token, I guess valuation are lower and leverage is lower. So you could argue that potentially the risk is lower. In Asia, Asia is less developed, especially on the buyout side, and which is where we growth capital and buyout, which is where we co-invest. But this is one of the regions, of course, where you have the most growth, and you have seen the most growth over the last 15, 20 years or so. So there's argument, pros and cons for each of the geographies. And I think the important thing for us is to build a diversified portfolio and remain opportunistic. In private equity, it's always hard to time the market when you're an investor. In private equity, when you have such duration, it's almost impossible, right? So our view, and we've been, I've been in this market for almost 30 years, and our view has always been you need to just be consistent in your allocation. It's very hard to time the market, and there are opportunities, in all the markets, provided that you work with the best fund managers. That would be our view.
Okay, so Peter, looking forward to hear your thoughts. But bridging over, a question is, but consider what we had said before, that a lot of this is piggybacking the GP. To implement a diversified and maybe even global co-investment strategy requires that you have established relationship with these people, right? So would you agree to that statement?
I totally, yeah. 2/3 of the money we manage is primary capital, right? So we sit on more than 100 advisory boards for GPs. So yes, we have a local, and in the mid market, it's very important on top of what you said to be local, because the local funds, the 500 million funds, they don't raise on a global basis, right? Yeah, absolutely.
Yeah. Peter, do you agree or disagree?
I agree, and I think that's one of the advantages of co-investment funds, that you can hardly build as an individual a co-investor, build such a number of relationships. Just to add to a typical co-investor, be it an institutional or a family office, I think what has to be borne in mind is that whatever you do on the co-investment side has to fit your overall asset allocation, the strategic asset allocation. So you have to basically sit down and consider how much, now you talked about countries or regions, how much do I want to invest in a certain region, etc. And then the co-investments in buyouts has really to fit that strategy. I think that's an important thing to bear in mind. So this is really on the co-investor side, be it family office or others. This has to be part of an overall process. What do we want to do, and what is exposure in that region already? For example, because we have seen that, let's say, if there's a crisis, it affects several asset classes, not just one. So I think that's an important exercise to be done if you are on that investing side.
Thank you. So I don't know. So we have a moderator. I think who has collected even more questions. Is that right, Luca? Are you there? No. Okay.
Oh,
so
we have a polling. We have a poll which would be interesting to look at the result if we have any.
Yeah, absolutely, we do. We do. So the poll has been. I mean, are we going to share a slide with everyone? But I can read them out again. So the poll was about, what is your preferred strategy to implement co-investment? And those of who participated, 31%, about a third, said we prefer to develop in-house capabilities. And equally, the same number has said we would like to establish a joint venture. And half of the participants said they prefer investing into a co-investment fund. So I think, this 50% preference in the audience, is in line with what we said there. There is a certain level of, let's say, professionalization necessary to implement a successful co-investment strategy. But at the same time, I'll have to say, considering our research, it's important that this co-investment fund, of course, doesn't eat up through the double layer of fees, doesn't eat up,
Sure.
Potential benefits, right? I mean, that's basically then a matter of negotiation or the offering in the co-investment fund market.
Yeah, if I
Sure.
can add my 2 cents on this, I mean, it's not surprising, and it probably depends, who is listening to this panel and the level of experience in doing private equity investment. But certainly, as I was saying before, when you have a large primary program, you tend to have those co-investment opportunities on a no fee, no carry basis, because it basically benefits the GP as well, right? They have an interest to offer co-investment to the preferred LPs or main LPs. So if you look at our experience, so we've completed more than 104 deals, since 2008, and more than 90% of those are under no fee, no carry basis. So that goes back to your research right now, that the benefit of doing co-investment and having a diversified co-investment program is only there if you don't have a double layer of fee. And of course, as you know, the fee and carry of a co-investment fund tend to be half, if not more, of a traditional buyout fund. So you get a better diversification than a buyout fund, 40 to 50 deals at a 1 and 10, as opposed to 10, 12 deals at a 2 and 20, right? So I think it does make sense for LPs. It seems to me that for those reasons, and as long as you work with professional investors, it has to be a quiver in your, it has to be one of the arrow in your quiver if you do private equity investments.
Yeah. So Peter, unless you would like to add something to this. So we got at least 2 questions on the parent topic. I think we will encounter throughout the entire day, which is ESG, right? So one question, for example, is what are your next steps in terms of ESG at this point? Someone else asking, what is your individual ESG metrics to analyze? So, for example, whether you currently use the SFDR classification, etc. I mean, is there something that comes to your mind specific to co-investments in the ESG context?
So, I mean, I'll take a very quick stab, if I may. So, you know, we're mostly a fund-of-fund investor, right? Which we do through SMA, separate managed accounts, and it's extremely hard to have an SFDR categorization of Chapter 8, which I think is the chapter which the most private institutional investor will be expecting from us going forward. If you know, if the underlying funds in your fund-of-fund program are not themselves Chapter 8. And the reality today is obviously SFDR is very recent, and you just don't know, and it's not very precise yet in terms of taxonomy. So most investors are staying on the cautious side and saying, you know, we're not changing anything, and all our funds will be Chapter 6, right? On the co-investment side, since you are, you know, sitting at the table with the GPs, and you actually do have access to the underlying data of all the investments you make, it's a lot easier to claim that you can be a Chapter 8. So we've decided that our fund will be Chapter 8. And to remind the audience, it's a new European taxonomy, which we welcome because it will eradicate, we think, greenwashing that there's a lot of in the market. So we really welcome this new taxonomy and regulation. And Chapter 8 is not Chapter 9, which would be an impact fund. Chapter 8 is really, you have ESG screening when you make an investment, and it's very thorough, and you agree to report on those very detailed ESG parameters to your investors. Yeah. That's what it says, basically. And I think it should be welcomed by all investors.
Yeah, absolutely. Peter, any experiences with ESG changes recently, or?
No, I mean, I think it's very clear that the awareness, in particular also of large institutional investors, is increasing in that area because they have their own clientele, which they have to justify themselves towards. So there is pressure, definitely. And I think these regulations will lead to more transparency in that regard, and that's a good thing. But indeed, I think we are lacking a number of details at the moment. Let's see how this shakes out.
Yeah. So a bit of uncertainty about the regulation that's ahead of us. So maybe one strategy from an academic who tend to be high on risk aversion, but they may be better to be on the safe side here. Okay, so I think we have 2 minutes left. Peter and Eric, is there any final statement you would like to share with the audience before I quickly wrap up the session?
I'm not sure it's a statement, actually. I'll ask you a question. When we were preparing this, you were talking about your next research, and I find it fascinating, especially in the you know, in the importance of selecting the right individual within a firm, within a GP firm, you know, to make sure you have the best deal maker, so to speak, and that the person who delivers the best deals. So if you have a minute to share, you know, your insight, I think that would be very interesting for the audience.
Happy to do so. Peter, is that okay? I mean, thanks. You know, so I think the overarching question there is, you know, whom to follow, the individual manager or the organization, right? And I think our research shows that actually the individual is much more important in explaining buyout returns, deal returns, than an organization it is. So in other words, you could reformulate this and say a successful private equity firm is one, you know, that attracts great talent and, you know, keeps it, you know, hungry and incentivized. So in a way, you could actually view a private equity organization as a labor market or a capital market who lets the stars shine, so to say. And I think that's the bottom line of the research, and is also, I guess, relevant to co-investments, because, you know, if we say we piggyback GPs, that could also mean you do as an LP, you know, you have a closer look at who's going to lead the co-investment, you know, within that organization, right?
And you mentioned that it's actually quite staggering, the difference, right? You were mentioning a number which I believe was 4 times more important to explain the performance. Then the individual is 4 times more important to explain the performance than the organization, which is a very significant number.
Yeah, and then relates, as we've spoken, it relates to first timers too. I mean, what's the problem with someone, you know, starting his own organization if he or she has a great individual track record? our research suggests there is no risk involved, so to say, because it's more informative about what's going to happen. Well, yeah, but thank you, Eric. Thank you that I got.
So we look forward to reading the paper if we can have access to it.
Yeah, pretty soon. Thank you. So let me quickly, Peter, if you want to add something, that's your last chance.
No, maybe just one cross-reference. On this private equity series in Paris, we kind of awarded or decided on the first Laureate Award on a research paper. And this was more basically on the level of investments, but there it had a similar question for the portfolio companies. What is more important, the horse or the jockey? Yeah. And it was also the jockey. So I think that's absolutely in line.
Okay, thank you. I was relieving. I thought you were going to kill me in the very end. So only very few seconds left. I think we've learned a lot. Let me thank you so much, Eric and Peter, for being with us today. And my key takeaway of this session is, if you don't like to be a co-driver, you have to go the hard way and work for a GP. All right, so thanks to everyone. Although we haven't seen each other, I hope to have the chance one day when we are back to normal somehow. Okay?
Thank you, Rainer. Thank you, Peter.
Bye-bye. Take care.
Bye-bye.